This is Matt Godleski with CapTrust Advisors, bringing you this week's edition of The Pulse. Here's what we're watching this week. Stocks continue setting records as the Fed stays put on reducing stimulus and economic data is showing signs of softness. Risk assets continued their march higher with a wall of money, corporate profits, and low interest rates supporting higher asset prices. The recovery continues unabated, despite potential tax hikes ahead, geopolitical turmoil in Afghanistan, and inflationary concerns. In reviewing the economic fundamentals, data shows a mixed bag. Consumer confidence hit a 6-month low as concerns over the Delta variant and elevated prices are weighing on Americans' views of the economy. Data from travel and leisure and higher prices on groceries and gas are further weighing on sentiment. At the same time, home prices jumped the most in more than 30 years in June. Buyers armed with cheap mortgages and limited home supplies fueled ongoing bidding wars. U.S. manufacturing activity increased from the backlogs built up from supply chain bottlenecks. Companies and suppliers continue to struggle to meet increasing demand. Record-long raw material lead times, shortages of critical basic materials, rising commodity prices, and difficulties in transporting products remain. Meanwhile, U.S. companies added fewer jobs in August than expected, reflecting persistent hiring challenges, adding to the struggle for manufacturers to attract and retain qualified workers. Vacancies remain high across industries, with most payroll gains concentrated in the leisure and hospitality sector. Overseas, euro area inflation jumped to the highest in a decade in August. The reading raised concerns that policymakers may have to act to rein in price pressures. The biggest news of the last 2 weeks was the outcome of the Jackson Hole Federal Reserve Conference. There were 3 main takeaways from the meeting. The Fed remains optimistic about the recovery, inflation looks to be transitory, and no changes to interest rate policy or asset purchases will be implemented currently. Investors now must assess how the Fed will define their policy going forward, as employment progress continues and inflation is above target. With the Fed on hold for any changes to policy, many worry that they risk a too slow taper that could lead to inflation remaining higher for longer. The difference from policymakers' 2009 through 2019 playbook is that post-pandemic, government spending has been magnitudes higher than in the last cycle. This was necessary to see the economy through the darkest days of the pandemic, though price and stability concerns are rising. Modest changes are being made to portfolios to better reflect the current economic and interest rate environment. September has a history of very weak equity returns, and we believe a pullback is long overdue. That said, corporate fundamentals remain robust for now, and our longer-term view is focused on staying invested in stocks versus fixed income. With interest rates likely to rise, caution and a thoughtful approach to bond investing remains crucial. As always, we remain focused on unfolding market dynamics and make changes only when appropriate. Thanks for watching.